Okay, I'd like to take this opportunity to welcome everybody to this morning's event. This is the January effect. It's Saturday, February 5th. You got John Hopkins here, Tom Bowley gonna jump in just a minute. Hey, if you're new to earnings beats, I want to welcome you to this morning's session. I think you're going to find it extremely informative, very timely. Of course, I want to welcome all of our wonderful members who've been with us, some of you for many years. Thanks for all your support over all those years. Today's event is being recorded for those of you unable to stick around for the entire event. No worries. It'll be recorded and you get a copy. And by the way, for those of you who are, again, new to Earnings Beats, we have pretty extensive webinar library, all kinds of educational information that you'll be able to listen to if you're a regular member, and also during your trial period. This is one of three-part series. Next 2 Saturdays will be follow-up. Also, a lot of events going on in February. It's just one of those months where just a lot going on, including Max Payne. We've got our model portfolio draft that's coming up. These other couple sessions that are coming up that I just mentioned, and a few others as well. And the best way to learn about what's coming up is on our calendar. Just go to the website, click on calendar, and you'll be able to see everything that's on tap. Anyways, I know there's a lot to cover this morning, so I'm going to step aside, let Tom take over, and time permitting, we'll have some questions at the very end. So have a good event.
All right, thanks, John. Yeah, we're going to jump right into this. We do have some great events coming up, as John mentioned. I'll talk about a couple of those in just a second. But first, let's go ahead and pull up the agenda for this event. I'm really excited to go over, some of the work that I've done, some of the analysis that I've done, and share it with all of you. So first of all, welcome. Appreciate everyone taking time out of their Saturday to be here with us. If you do need to leave at any point, as John mentioned, we are recording the event, and we will make sure a copy goes out to everyone who is on our EB Digest. That's our free newsletter. And if you've come in directly from my article today, we'll make sure we get you added to the newsletter, so you don't need to sign up into the newsletter directly, although you can if you want. So just wanted to kind of get all of that stuff out of the way. So if you do need to leave, it's not a big problem. We will be able to send out the recording to everyone. The next thing I want to talk about was this February educational series, because this is something that we enjoy doing at Earnings Beats. We like to educate. We like to have these events where, for both the public and for our members. Today's event is completely free, open to the public. I think it provides a lot of great information. It's just one more piece of the puzzle that we can put together in trying to figure out, what we think is going to happen in the market in 2022. So we'll go through and talk about those 3 events. Then I'm going to bring up a couple of charts just to help explain a little bit about what I mean by the January effect. So before we go in and look at some of, a lot of numbers on a spreadsheet, I want to show you on the charts the S&P 500 and what we mean by the January effect and how that can impact the balance of the year performance. And then we'll wrap up with that January raw data. Now, for those of you who don't know, my background, I was practicing CPA for more than 20 years, both in a large firm and then on my own for a while. So I really enjoy analysis. I love digging into the market, trying to figure out what makes it tick. The historical component, I think, can be very, very important. It's not the only component, but it is one component. So I think it's worth looking into. So we're going to get into some of that data, and I'll show you some of the things that I've interpreted from that data over the years. So I'm going to go ahead and jump in. Let's first go in and take a look at this educational series. So everyone should have up now on your screen the live webinar events. And by the way, if you're at our homepage, I'll just go back over to the homepage first. you can get to this information. We have a link right here on the home page where you just click on that. It'll show you the 3 events. So that'll bring you to this page. So first, what we're going to do today is talk a little bit about the January effect and how January performance can have a pretty big impact on the balance of the year. You wouldn't maybe think so, but 1 month's action does tend to give us a little bit of a clue as to what we might expect the rest of the year. Next week, I think this is going to be a critical session. A lot of folks, especially if you've only been investing for the last couple of years, you don't even know what a cyclical bear market looks like. You don't know what any kind of a bear market looks like, because since we went to the bottom in the pandemic, we've been going straight up. The S&P 500 from the March 23rd low to the early January high just a month or so ago, we were up like 109%. I mean, it was crazy how much the market's gone up. Maybe it was more than that, and maybe it was closer to 115%. I don't remember the exact number, but it was a big number. And to do that in less than 2 years is kind of crazy. So you need to at least have an idea of what these cyclical bear markets look like, how long they last. And so what I'm going to be doing is I'm going to be doing the anatomy of prior cyclical bear markets so that we can take a look at history to get a sense of what we might be looking at in 2022. Because even though we haven't reached bear market territory, which is defined as 20%, which, you know, is it 18% or is it 21%? Who cares, right? I mean, it's still a lot to the downside. So we'll be looking at what I consider to be significant declines, which others will describe maybe as a bear market. I may look at a couple of drops that maybe fell just short of being bear market, you know, maybe a little less than 20%. But the whole idea here with this session next week is to gear up and lower your expectations for 2022. Hey, if things turn around and we move back up above moving averages and we're trending higher and the supporting sectors are aggressive groups and everything starts to look better, that's wonderful. But I don't think right now we should be thinking along those terms. The market needs to prove that to us. I think we need to go with what the market's telling us right now, which is that we are more likely than not going lower. So next week's session is going to be really important. And then if I'm right, and we do go through this cyclical bear market, I believe there are going to be some growth stocks that are going to be unbelievable bargains going forward, because I do not believe we're in a secular bear market. I don't think this is a long-term bear market. I said it at the beginning. I said it when we were at 50, right at all-time highs, that I thought we were going to have potentially a cyclical bear market coming in 2022. But if we turn around after that cyclical bear market and move right back up to all-time highs, which I believe we're going to, this third session is going to focus on some of the stocks you're going to want to at least have on your radar, because you see how fast these growth stocks are moving to the downside. Well, when inflation tops and starts moving down and the threat of higher interest rates abates, you're going to see growth stocks moving up just as fast as you've been seeing them move down. So you're going to want to have your list ready, and that'll be session 3. The next 2 sessions are for our members only. So if you go through this event, you like it, keep in mind a trial subscription to Earnings Beats is free. 30 days, no cost. The only difference between session 1 and sessions 2 and 3 is that if you want to go to 2 and 3, you'll have to provide a credit card, because we'll have to get you set up in our system. But otherwise, they're all free. So it would be, I think it would be great to join if you haven't already, or if you're not already a member. Anyway, you can scroll down, you can find out some more information about each of these events. So, and there's a sign up form if you want to be a 30-day free trial member. There's also a form right here if you just want to sign up for our free newsletter. You can do it on this page as well. Anyhow, that is the upcoming events. I wanted to go through that. And now what I want to do is share with you a couple of charts on the S&P 500 and give you a sense of what we're looking at. Now, when I go through all the data, what I'm going to do is I'm going to break down into 4 quadrants: the best quartile of Januaries on the S&P 500 down to the worst quartile. So we'll have the top 25% of January performances by year. Then we'll have the next 25, the next 25, and then the final 25. We'll go from the most bullish to the most bearish. Now, just to give you an idea of what we're talking about, so that when you look at these numbers, maybe it'll make a little bit more sense to you, I pulled up 1954 on the S&P 500 because in 1954, January of 1954, we saw the S&P 500 go up 5.12%, which places it in that top quadrant, the top 25% of Januaries. It's kind of right in the middle. It's not the best January, but it's one of the best Januaries on record. So that plus 5.12% in January preceded this balance of the year move of an additional 37.96%. So when we get to the spreadsheet, you're going to see things like January performance, February to December balance of the year performance. That's what this is, February 1st to the end of the year. It doesn't include January. So you might say, well, yeah, 37.96%, but that includes 5%. I'm saying, no, it does not include the 5%. We had a strong January. And then on top of that, we went another 37.96%. So these January performances, as you'll see in a couple of minutes, tend to suggest that we will see more strength ahead. Now, does it mean that if you go up 5% in January, you'll go up 38% the rest of the year? No, that was this particular year. There are all kinds of different gyrations. You can go up 5% in January and go down 10% the rest of the year. It's just not as likely. And I'll show you the odds and probabilities in just a minute. So here is one of those charts that I wanted to show you. So this is the January performance followed by balance of the year performance in 1954. And you'll see this year in our top quadrant, our quadrant number one, our bullish quadrant in just a couple minutes. The other chart I'll show you is what happens on the downside. So later in that decade, 1957, see how January went down 4.18%? Well, over the course of the rest of the year, we went down another 10.58%. So from February to December. So the entire year, we actually went down closer to 15%, but we went down over 4% in January and then another 10.5% the rest of the year. Now, look at what happened during the year. It went up, and then it went back down. So there, could be volatility. There could be a lot of movement in both directions. The point is, where do we finish the year? And how does that balance of the year, February to January or February to December, how does that compare to the January performance? All right, with that as a backdrop, I'm going to show you some numbers. So let's let me bring up this Excel spreadsheet. Well, it's on Numbers, which is in Apple's Excel version. But what I have here, I've got two tabs. I've got the S&P 500 and I've got the NASDAQ with these numbers on it. So I started off this first part of this spreadsheet, if you will, is going chronologically from 1950 all the way down to 2022. The first column is simply what did we go up or down for the year? So we take the December 31st, 1950 S&P 500 number, subtract the 1949, December 31st, 1949, and take that difference and divide it by December 31st, 1949 S&P 500 number, okay? So that just gives you the percentage for the year. Now, January is just going to look at January 1950. So it's just looking at January 31st and then looking back to December 31st, 1949 and figuring out, okay, did we go up or down and by what percentage? And then the February to December number is looking at the S&P 500 at the end of the year, subtracting the January 31st balance, not the December 31st balance, but the January 31st balance to see how much more we went up from January's close. Now, if you take these two numbers and you add them up, you'll come up to 22.16. which does not equal 22.63. And I get this question all the time. Why is that? Well, remember, this number is being based off of the December 31st number. This number is being based off the December 31st number. But this number is being based off the January 31st number. So you're not looking at the same denominator on all these. That's why if I took the gain from February to December and divided it by the December 31st number, then you would be able to take these two and add them together and equal. That's not what I did. So I just want to be clear as you're looking at these numbers, because sometimes you get, thrown off when something doesn't add up and then you don't pay attention to the rest of what we're talking about. So I just want to make sure everyone understands that there is a slight difference. If you add up January and then the balance of the year, it's not going to equal the full year. It's going to be off a little bit. And the bigger this January number is, the more it'll throw you off, because that changes the January 31st number from the December 31st number by more. Anyway, those of you who don't do spreadsheets and aren't big fans of math, probably your eyes are probably glazing over right now. So I will stop on that computational side of things right there. Now, so that's all this is. This is just 1950 full year, the January performance, and the February performance. Now, as I scroll down, what I did is I sorted all of these years by the January performance. And if you go from 1950 through the year 2021, which we just ended, there are 72 years in that period. So when we break down the best Januaries, if we break it down by quadrants, we can put them into 4 separate quadrants with 18 years in each one. Okay. So what I did is, again, you're going to see like 1987. See how January went up 13.18%? Well, when we come down to quadrant 1, which is the very bullish quadrant, there's January, very first one. That is the best January on record, 1987. A lot of folks don't realize that. Everybody thinks 1987, they think crash, which occurred later in the year in October. But it was a strong year heading into October. Even though we had a crash, 1987 actually finished up 2% that year. So yeah, it was a crash, but it was a crash after we had a huge move to the upside. So again, a lot of that gets lost, when you look back at history sometimes. All right. So here are the top years. So 1987 was the best January. 1975 was the next best January. 76, strong January. 2019. And so I'm not going to go down every one of them, but you kind of get the sense. See how they're all in order of January performance. And then what I have here is the balance of the year performance, and then the total full year. Okay. Now, the things that I think are important is just look at the averages of these different quadrants. So in quadrant 1, the average January gain, if you're in this quadrant, you're in a quadrant where the average January gain is almost 7%. Now, keep in mind that the average yearly performance on the S&P 500 is 9.49. So you might think, well, if January is 6.96, then, the rest of the year probably isn't going to be very good, because we only averaged 9.49%, and we just got 7% of it in 1 month. The rest of the year shouldn't be very good, right? Well, that's not the way it lines up. The rest of the year averages going up another 15%. So when you get a strong January, the tendency is to follow it up with a strong balance of the year. Going back to that 1954 S&P 500 chart that I showed you. By the way, 1954, here it is. There's that 5.12%. There's that balance, 37.96%. We actually went up 45% that year, which among all of the strong Januaries, that actually turned out to be the best year. So I gave you a really good one as an example to look at. But when you look across the board here, and over here on the right-hand side, what I did is I broke down the balance of the year. So what I'm doing is I'm breaking down this column right here. So of these 18 years, and that's what this 18 is over here. Of these 18 years, February, December period, 16 of them went higher. So after having strong Januaries, the balance of the year went higher 16 out of 18 times. Only went down twice. I mean, if you look, 1987 and 2018, the only 2 times we have had a strong January, one of the strongest Januaries, followed by a down period the rest of the year. Otherwise, the other 16 are all higher. And breaking down these 16, where I looked here to see if, what years did we gain another 20%? So there was one. Here's one, here's one, here's one, here's one. So there's your 5. Those 5 years saw not only strong Januaries, but saw balance of years that were over 20%. Now, if you add up all the years that went up another 10% after January, you'd see that there were 13 of them. And then balance of the year going up at least 5%, there were 16 out of 18. So I think we can conclude based on this, that if you're in that strong quadrant of January performance, you've got a really good chance of seeing continuing strength to the upside. In fact, that average balance of the year performance, more than 15%. And when you combine it with that January performance, these years average going up 23%. The average over 72 years is 9.49%. I'd say that there's a very, very bullish tendency, the balance of the year, if you have a strong January. Hopefully everybody looking at this can understand that and would come to the same conclusion. Now, does it happen every time? Is it a guarantee? Well, 1987 didn't work. 2018 didn't work. So no, it's not a guarantee. You have a great January doesn't mean you're absolutely going to have a great rest of the year. But I think as you go through these other quadrants, you'll see that the odds in this quadrant are much better than in the other quadrants. So let's go. And by the way, before I go to that, I want to just kind of point out here, this average that I put in for the S&P 500, when we look at the NASDAQ tab, it only includes 1972 because NASDAQ began in 1971. So the NASDAQ only goes from 1972 to 2021. And what I did is I gave you averages for the S&P 500 over those same years so that we can compare S&P 500 performance to NASDAQ performance for that period. And you can see it's 9.39. The one thing I'll show you in the NASDAQ is when we go down here, NASDAQ over the same period, 13.35% versus the S&P 500, 9.39. So over the last 50 years in US equities, over the last 50 years, the NASDAQ has outperformed the S&P by an average of 4 percentage points. Now, not every year, obviously, will the NASDAQ outperform, but many times when it does outperform, it really outperforms. And the reason being is the NASDAQ has more of a concentration in growth stocks, technology, consumer discretionary, communication services. Those are going to be much more represented in the NASDAQ than they are in the S&P 500. So just keep that in mind, because if you're, younger, you're not close to retirement, and you've got a retirement plan where you're not going to be needing the money for at least 10, 15 years, I would be waiting more of my retirement to some more of the aggressive areas. That's just me. You don't have to do that if you don't feel comfortable with it. But I'm just telling you, history tells us, you're going to take a little bit more risk, but 4% a year can do a lot for a portfolio over an extended period of time. Do the math sometimes. 4% multiplied over and over every year. That compounding effect is incredibly significant. So just wanted to point it out. All right, let's move on to quadrant number 2. So quadrant number 1 is where I say very bullish. These are the most bullish Januaries, 13% down to 4%. That's the ranking of the Januaries that fit. So you got to, in order to get into this quadrant, you have to have a January that goes up more than 4.15%. Anything less than that would fall into the second quadrant. So quadrant number 2, here are the Januaries. They go from 4.1% down to 1.73%. These 18 years. The average January performance of these 18 years, 2.9%. Balance of the year, 10.21%. You see the drop? So your January performance is down 4 percentage points. Your balance of the year performance is down 5 percentage points. And so you're now down 9 to 10% on average in those years. But that average 13.38% still compares pretty favorably to 9.49. So if you have a reasonably strong January, maybe not in the top quartile, but you're in that second quartile, your tendency is still to have a pretty good year. And then when we go and look at this balance of the year right here, you can see the years higher go from 16 down to 15. So you still have mostly higher years the rest of the year. And the years lower are only 3 instead of 2. So you do have one more down year of those out of those 18. And then look at the years greater than 20%. Again, I'm looking at the February through December performance. 20%, if you go down this column, there's one, 1995, and there's one, 1955. Only 2 years where we've gone up more than 20% the balance of the year. So 2 out of 18. Up here, we were 5 out of 18. So you can kind of see that it's already beginning to take a little bit of a toll. Then years greater than 10%, 10 out of 18 versus 13 out of 18. So again, you get into the second quadrant, there's not quite the same likelihood that you're going to get these 10 or 20% moves in the balance of the year. Now, 5% or more, 15 out of 18 compares pretty comparably to the 16 out of 18 there. But hopefully you can see as you move from quadrant 1 to quadrant 2 of January performance, your balance of the year performance deteriorates. Still bullish, but deteriorates. So let's try quadrant 3. Quadrant 3, in my opinion, starts to turn more bearish. So we start off with the S&P 500 January performance at 1.56%, going down to minus 2.53%. These 18 years all fall in that range of January performance. And then I go through to do the same thing, February, December, balance of the year. And look at these averages. So now in this third quadrant, the average January performance is actually slightly lower, down at about minus 0.5%. Look at what that does to the balance of the year. Just 2.5%. And so the full year is only 2%. That 2% now versus 9.5%. So if you have a January that falls in this third quadrant, you've got to lower your expectations based on history. Now, does that mean we can't have a great year? No, 1998, look at that. 1%, it's in this third quadrant, but we went up 25% the balance of the year. So it happens. Here's 28%, 2021, last year. So if we had been following this last year, we probably would have had muted expectations, and yet the market would have continued going higher there. Although growth stocks certainly underperformed, but still the S&P 500 as a whole went up 28%. Those were 2 outliers. Those are your 2 years where you went up over 20%. How many did you go up over 6 or over 10%? Well, you know, you're getting fewer and fewer, but there were 6 of them. 6 out of 18 went up more than 10%. Compare that to 10 out of 18 or 13 out of 18. Do you see the odds dropping? Years greater than 5%, 10 out of 18 versus 15 out of 18 versus 16 out of 18. So once again, your odds of performing well, the balance of the year, not as great. Balance of the year, just finishing higher versus lower. 12 out of 18 went higher. 6 out of 18 went lower. So you still got a 2-to-1 chance that you're going to go higher if your January falls in this quadrant. But you can see by the average returns, you've got to lower your expectations. All right. And then finally, we get into the most bearish quadrant. Now, the average return for the balance of the year is actually stronger than the third quadrant, but you can see the January performance itself average is much, much lower. And so the total return, if you have a bad January, your average return is going to be less than 0 for that year. That's the average. So obviously there's some pretty bad ones. You've got 2008 in here where you went down 38%. That was pretty bad. And then you got multiple, others that were over minus 10%. 2000, 1977, 1957, 1962. So as you look at this, the number of years higher, 12 to 6, same as the third quadrant. 2 out of 18, 6 out of 18, and then 8 out of 18. So there you take a little bit of a hit versus that third quadrant. The point is, if you start having more bearish Januaries, the odds of you just ignoring it and then just turning right back around and going higher, the odds are not nearly, I mean, nowhere near what you have if you're up here in these top two quadrants. And just to break it out even further, what I did down here at the bottom is I just lined up all the positive Januaries. So starting with that 1987 January, going all the way down to this last one, which was in 1986. These are all your positive Januaries. That's the average for all Januaries that went up. Here's the balance of the year return, 1189. So if you have a strong January, if you're positive in January, you average going up 16.66%, which is probably about 80% higher than this 9% average, 9.5% average of all the years from 1950 to 2021. So that number's, pretty unbelievable, I think, when you just look at it and compare it to the negative January years, which I'll do it in just a minute. So there are 43 years where January's been up, 43 out of 72. So what you'll see when we go down here is 29 went down. 43 Januaries went up. The balance of the year saw February, December rise 37 of those 43 years. That's pretty strong. Look down here at the bottom, 29, only 18 of the 29 went up. On a percentage basis, that's under 60%. On a percentage basis, that's over 80%. So you can see the odds are definitely favoring the strong or the positive Januaries. If you want to go up another 20%, the balance of the year, 8 out of 43 years, you did it 8 times if you had a positive January. If you had a weak January, you've only done it 3 times out of 29, which is roughly 10%. So if you have a bad January, only 1 in 10 times would you expect that you're going to go up 20% the balance of the year. And if you had a bad January, if you had a negative January, the chances that you're going to go up the balance of the year more than 10%, only 9 out of 29. That's about 30% of the time. So 7 out of 10 years, you're going to go up less than 10% the balance of the year. So don't look for a runaway bull market when you have a negative January. Going to go up greater than 5%, not even half. Go up greater than 5%. And I want you to take a look at the averages here. For positive Januaries, look at the averages for negative Januaries. I mean, the average positive January is 4.2. The average negative January is minus 3.6. Look at the balance of the year. That's 9 percentage points difference on average. If you have a strong January versus just a positive January versus a negative January. And look at the average annual returns, 16.6. And if we look at these 29 years, January goes down. That's 29 years. That's a lot of the years out of the last 72. I mean, that's pretty good. That's 40% of them. The average return of those years is minus 1.14%. Now, having said all of this, you know where we just finished? January of 2022, minus 5.26%. So that is going to put us in this bottom quadrant right here. Just worse than this 509 and just better than this 612. There have only been 6 worse Januaries. Now, if you want to see the silver lining, the 5 worst Januaries all had balance of year returns that were positive. So from where we finished January, which was 4,500 or so, 45 something, I don't remember what the number was, but where we finished January, if we were to gain 5%, that might take us back close to where we started the year. So is that what we're going to see? Or is it going to be one of these minuses where we continue to go lower? I personally think that it fits pretty well in what I expect, which I think we're going to go down for the first half of the year. Maybe it's only going to be a few months, but I think it could be 3 to 6 months. Maybe it even lingers and drags and, throughout the summer. But I think by the time we get into the fourth quarter, if not sooner, I expect we're going to be back in full secular bull market mode again. And as a result, I think we go down, and I think we're going to have a cyclical bear market. At some point, we'll reach that 20% threshold or something pretty close, maybe more. And then I think we're going to rally back later in the year. So I'm not expecting that we're going to see -5.25. And then next year, when we take a look at this, see that the balance of the year went down another 20%. I don't think that. I don't believe we're going to be sitting at 3,500 at the end of this year. Could it happen? Of course, anything can happen. We could be at 2,500. I mean, we've seen the market. It's completely unpredictable. But when you're looking at technical analysis, you're trying to manage your risk. When you're looking at historical information, it's all about probabilities. So it kind of fits in with trying to manage risk. I would just simply say, based on what we're seeing here on these numbers, that the January drop of 5.26% should maybe not eliminate, but you should not be expecting that we're going to finish this year at 6,000 on the S&P 500 and that we're going to be up another 25% this year. The odds of that happening, you can see down here in the very bearish quadrant, only twice out of 18 years have we seen a 20% return. That's the balance of the year. So that's working off of the January 31st balance around 4,500. 20% on that would take us to 5,500. So the chances of us getting back to 5,500 by the end of this year, it's only in the past, it's only happened twice out of 18 years when you've had a rough January, where you've had that kind of return over the balance of the year. So all I'm saying is lower your expectations. The market just went up over 100% in about 22 months. That's crazy. And I know it's coming off the 35% drop. You got to keep everything in perspective. But even if we looked at where the S&P 500 was back before the pandemic, I think the move in the S&P 500 over those next 2 months was like 55 or 60%. So it's not unprecedented, but we've made a big run in the market. It needs to have a pullback. And I think the higher inflation scare, the higher interest rate scare, and all the media that's going to be pouring in, I think all of this is going to enable sentiment to reset, which is one thing that I've been talking about a lot since December. We need some bearishness in the market. If you want to launch, if you truly want a secular bull market launch where you can pretty much go all in and not worry so much, you've got to get sentiment to a point where most everyone is turned bearish. Once everyone's bearish, there's no sellers. Right now, everybody's bullish. So as long as we continue to struggle, we have to build that bearish negative sentiment, and it's going to take a while. You don't just have a couple of bad days or one big decline and that's it. In order to truly reset sentiment, we're going to have to see probably at least 3 to 6 months of struggles. So, and I think this kind of fits right in with that. I really think that what we're looking at here in terms of January performance fits right in. Now on the NASDAQ, I think the last time I did this January effect webinar, I did the S&P and I didn't have the NASDAQ and I had questions. Well, what about the NASDAQ? So I did the NASDAQ. So I did the same thing, 1972 in chronological order, showing full year first and then January and then balance of the year. You come out down here and there's that average return on the NASDAQ, 13.35%. It's done much better than the S&P 500, probably about 45% higher, going from 9.5% to 13.3%, 40% maybe, I don't know, 45% higher. But in terms of basis points, that's almost 400 basis points in return on the NASDAQ versus the S&P. So that's the first thing I'd point out. And then you can see the average January return, average balance a year. Now we go into the quadrants. I'll just go through it a lot quicker. It's going to be very similar. And as I go through, you can look at the recording and see some of these numbers. So I'm not going to pay any attention to these ones on the right, but just look at the quadrants. The average January gain if you're in the top quadrant, 10.55%. February, 14.42%. February to December, 14.42%, 25. So even after having strong Januaries, the balance of the year is higher than the average return for all other years. And so you can see that total return. If you have a strong January on the NASDAQ, that total return jumps to 25%, which is almost double the average NASDAQ return. It's good to be in, to have a strong January, but you have to get to 6.86% in January just to get into that top quadrant. By the way, on the NASDAQ, there were 25 years. So what I did is I put 13 years in the top quadrant, 12 in the second, 12 in the third, and 13 in the bottom. So kind of gave that extra year to the top and the bottom quadrants. Anyway, second quadrant. So this is where we move to bullish. We go on January return from 6.65% down to 3.05%. Here's your balance of the year return. Here's your full return. So here, January is 4%. Actually, we almost do as well balance of the year as we do in the first quadrant. So you can see the bullishness still remains. And the total average for the full year of years with strong January is 25.09%. The second quadrant still 18.65, which is still more than 5 percentage points above that average of 13.35. Now let's move into the third quadrant. The average January return now is just barely above zero. And you can see we go from 2.97% down to minus 2.13%. Here's your February to December returns. Here's your full year. And the percentage balance of the year, 11.99. That's not bad. It's dropping, but it's not bad. And then you have the total 12.74. So, you know, if you just have kind of a slightly lower to slightly higher January on the NASDAQ, the tendency is you still have an okay year. Then we go into the very bearish quadrant, where the average January returns go from minus 2.24 to minus 9.89. And February to December, you can see the balance there, and there's the full year. Look at what happens. Now we get a big drop off. So when we've had bad Januaries, all of a sudden, look at what happens to the balance of the year, February to December, only an average going up 2.5%. Some really good years, 2009, which by the way, was coming out of the bear market. But we also had some really bad years. You can see 2000, which started the bear market, one bear market, that was the .com. 2008, which was during the bear market, the financial crisis. Excuse me. So you got numbers all over the place, but the average is only 2.5%. Big drop from these prior quadrants. And the average return, total return for the year, top quadrant 25, second quadrant 18, third quadrant 12, last quadrant minus 2.71. You want to know where we fit in 2022, January, NASDAQ? Minus 8.98. Right here, second worst NASDAQ, or second worst January performance on the NASDAQ since it started. Now, does that mean we're going to continue down? I don't know. I think we're going to continue down for a while. We'll see how we finish the year. Again, just pointing out that it is in the bottom part of the worst quadrant. So the chances of just miraculously coming back, in this case, going up more than 20% balance of the year, only 3 out of 13. Gaining even just 5% balance of the year, 7 out of 13. So it's a 50-50 proposition just to gain 5% the balance of the year. Again, lower your expectations. Now, I did the same thing down here. I broke down positive Januaries. You can see the average January for all the positive years, 6.15, balance of the year, 1386, total 20.16. The negative, minus 4.25, you get back basically what you lost, and then you finish flat for the year. But look at the difference there. 0% average if you're negative January versus 20% average if you're a positive January. That is what I refer to as the January effect. So that's really what I have for today. So we went on only about 45 minutes. That's not too bad. But I don't know. John and I were having problems communicating. So I don't know if
Hey,
he's.
Tom,
Yeah.
I'm good.
Oh, okay, good.
Yeah, we have a couple questions.
Yeah. What do we got?
Well, first one always comes up. Can we get this Excel and member section? Will that be an annual perk? Or I don't know if you're going to put it in there.
Yeah, I'll put it in there, but it definitely is annual. I mean, there's a lot of research that goes into this. So what we
Okay.
do, for those of you who are new to Earnings Beats, we have some things that we have a lot of things we share with all of our members at Earnings Beats, but we do reserve just a few things that where we've spent a lot of time on things. If you commit to us for a year, then you can have a lot of the research that we've spent literally hours and hours and hours and hours and hours on. So this will fall in that category. I think Aaron already has a copy of this, so we can get this up on our website probably by, certainly this weekend.
Okay. Hi, Tom. Great analysis. Thank you. Question. Makes sense to me that the same rationale would apply to sectors. Would you agree? And do you have any data on sectors?
That's the next one, I guess. Yeah, I would think, the NASDAQ leads the technology group tends to lead the NASDAQ. So I'm sure that the technology group is going to be fairly similar. It won't be the same, but I would expect it to have similar results. I think when the market's weak, the tendency is that, you favor defensive groups and not aggressive groups. And I'm sure that it would line up just like that with January performance of technology stocks if you were looking at the XLK. The problem with that, though, is the XLK, the sectors were only created, I think, or the ETFs that track the sectors were only created, I think, in like 2001. So you can only go back about 20, 21 years. So you're not going to get a full representation like you're going to get with the NASDAQ and especially with the S&P 500.
All right, here's somebody that's paying attention. Why does he keep comparing the full year percentage in the quadrants to the January only percentage in the all year section? Shouldn't full year be compared to full year?
I'm not sure I follow that. Read that again.
Why does he keep comparing the full year percentage in the quadrants to the January only percentage in the all years section? Shouldn't full year be compared to full year?
Well, remember, these are flipped. This is January, balance of the year, full year. Up here, it's full year, January, February. So the full year, this is the full year. So when I'm comparing this full year or the percentage down here, this average, and I go back over here, it is full year to full year. It's just that we flip the columns because up here, I just listed in chronological order all the years because January is not in any kind of order. It's random. So what we did is this is just chronological. So it didn't really matter to put January 1st. In fact, that might have been more confusing, I think. Aaron and I actually went through this trying to figure out the best way to present it because I do think it is a little bit confusing. But just remember that the chronological order at the top that shows all the years, full year is that left column. So when I am looking at and comparing full year in each quadrant and going back to a different column, I'm still looking at full year. It's full year to full year.
Okay. You might have already touched on this, but somebody's asking basically if we do go down, where do you think realistically the S&P could finish by the end of this year?
Well, at the beginning of the year, in the Market Vision 2022 event, I said I felt at a minimum we would see 4,300. That was the minimum. That was a 10% correction. And I just saw I think it was the September low or maybe beginning of October, right around 4,300 is what I felt would be a magnet. And so what I've been telling members since then is I thought initially we might see a move below 4,300 with a reversal. And we did. And the reason was the volatility index just got to a point where it had gone off the charts. It was like 39. And we just don't see VIX readings up near 39 very often. That's telling us that the market is panicked. The kitchen sink is being thrown out. Everybody's selling. And that's normally where you get a reversal. So we got that reversal. We got down to 42.20. And then I think we reversed back up to like 4,400 that day. But we've established a clear neckline, in my opinion, at 4,300. If we break that 4,300 level, I think we go to 3,800. That would be my next target. Do I think we could get to 34, 3,500? Yeah, I think it's possible. I've got a long-term channel that I follow on the S&P 500 with the tops being connected and the bottoms being connected. And then I've got a middle line that's dotted, if you remember, or even, I've had that in some of my blog articles over at Stock Charts. But I think 3,500 intersects with that dotted line going up. And we've had multiple tests of that dotted line, which is kind of in the middle of the highs and the lows, if you can just picture this channel. So 3,500 is an area that I think that would kind of, if we got to 3,500, I think that it would be a great buy to get into the market based on everything I'm seeing now. Now, maybe we have a lot more news and maybe a lot more signals in the market and everything else that we'll be evaluating as the year goes on. But just based on where we are right now, I think 4,300, the initial move to the downside, I think potentially as much as 3,500. My guess would be maybe closer to 3,800.
Okay. Tim's asking, what about performance in the 4 quarters after decline in January? Is there a pattern?
In January, say that
Yeah,
again?
what about performance in the 4 quarters? If there's a decline in January, is there any pattern that you know about?
Well, one thing looking at quadrant 4, that's what it sounds like the question is, and what kind of pattern? I did see like sometimes in January, here's one, like January of 2003, that ended, the bear market ended in March. The secular bear market that started with the dot-com bubble. So that initial bear market from 2000 to 2003 ended. I believe it was in March. It might have been in October of the 2002. I can't remember exactly where that bottom was. Anyway, I thought that was maybe an anomaly. The fact that we bounced back 29%. One of the things you find about the stock market, one of the best times to be in is at the end of a bear market. That first initial move to the upside is very difficult to be in on because everybody is so bearish. But if you're in on it, it is a massive move. So sometimes you'll see, 2009, here it is, 2009, worst January on record for the S&P 500. And we had a great return the rest of the year. Well, we ended the bear market there. So the only thing I would say is that these 2 great years that we had that were over 20%, both were coming out of 2 to 3 year secular bear markets. I would almost eliminate, we're not in that position right now. We're coming out of some great years. We're not coming out of bad years. So if those are the 2 exceptions to the rule, where if you're going to go over 20% balance of the year, and both of those were the end of the two of the worst bear markets we've seen. So I don't know that I see any patterns, but I would simply add that maybe as a little caveat there. These 2 good years both followed 3-year secular bear markets. Maybe we should toss them.
Okay. Let's get a couple more in here. Since we are in a secular bull market, shouldn't we look only at data from secular bull market years?
Well, you're going to see some secular bull market years in here. 1950s and 1960s were secular bull markets. Here's a bad January, a little bit of recovery. I would expect, I think that's a great question. I don't think that you're going to see minus 20% the balance of the year. I just don't see it. I don't think we'll finish at 3,500 this year. We might touch it. I don't think we'll finish it. But if you look at the secular bull market years of the 1950s and the 1960s, the 1980s and the 1990s. So as you go down this list, you can look to see what has happened in those secular bull market years, if you're interested in doing that. And then I would say the current years, to me, the secular bull market began in 2013, because that's when we actually cleared the 2000 and 2007 top. Some might say it started in 2009 at the bottom. It's all up to interpretation. For me, we don't have a breakout. We don't end those years of sideways action until we make the breakout. We didn't do that until 2013. But anyway, I think that's a great question. I hadn't even thought about that. But I think that a lot of times, if you're going to have cyclical bear markets within secular bull markets, if you do have a down January, I would expect maybe the balance of the year to be positive, maybe not huge positive, but, and that's kind of what I think now. I think we'll either be flat. I think we're going to get back up close to flat by the end of the year. Maybe we're down a little bit. But after losing 5% or so, I mean, even if we're flat, we finish right around 4,500 this year, which is very possible. But that would be interesting to go through here and look at those secular bull market years. Great question.
All right. Okay. What type of market action would you need to see in the near term that will cause you to change your mind regarding going into a cyclical bear market?
Well, the first thing we'd have to do is reclaim those moving averages. You know, when you get into a cyclical bear market, you start trending lower, number one. Number two, I think it's the makeup. It's not just whether the S&P 500 goes up or if it clears moving averages, but what's leading it on that move to the upside. I mean, if we go up and we look, you know, we're looking like we're getting strong again, and then I look and see that real estate and utilities are leading the move to the upside, I'm not going to be as impressed as I'm going to be if technology and consumer discretionary and financials and those types of areas are leading the move to the upside. So, you know, it's not that easy just to say it's one thing, because I always say, you know, trying to evaluate stock markets like putting a puzzle together. You know, you can all, if you want to be bullish, and this gets back to Dave Keller's comments about bias, you know, that you have in the market, that you're always trying to confirm your own bias in the market. And so if you're naturally bullish and you don't believe the market should be going down, if you see one thing out there that's bullish, that's what you hang your hat on. You say, yep, I knew it. We're still bullish. But for me, it's more about putting the puzzle pieces together. And there's a lot of different puzzle pieces, the intermarket relationships. And for those who say, well, how can you possibly be thinking this secular bull market still, given all this? Think about where we are in interest rates right now. I mean, interest rates are still near historic lows. Yes, they're going up. You know what? If they go up 5 times, they're still going to be much closer to the historic lows than they are to areas where I think it could present problems. So if you've got decent growth and you've got near historic low levels of interest rates, the stock market's going to do well. That's history tells us that. So yeah, I mean, interest rates, anytime you get the threat of interest rates or you get actual interest rate increases, the Fed funds rate gets bumped up by the Fed, that changes things. I mean, banks immediately start changing their rates and it starts to have an impact on the economy. Do I think going from, you know, 0.25% to 1% on some of these short-term rates is going to make a big difference? No, I don't. Short-term, it's going to scare the heck out of everybody, which I can't change that. I mean, it's going to be in the headlines. CNBC is going to talk about the media. I mean, you're just going to hear about it nonstop. Think about where we are now in the pandemic versus where we were 2 years ago. The media, everybody had everyone convinced that it was Armageddon. It was the Great Depression 2.0. Hey, it was a horrible healthcare crisis. I'm not trying to diminish the healthcare side of this. I'm just talking about the financial side of it, the stock market. I kept saying, we're in a secular bull market. This is not the end of the secular bull market. And so you have to separate news stories and media from the truth. And the truth is in the charts, and understanding the charts, understanding the intermarket relationships, and just understanding the big picture that asset classes go through long-term cycles. They don't just go bull market, bear market, bull market, bear market. They go through decades of strength and then look out. And I believe come the hopefully not the 1930s, but the 2030s, you know, it's kind of interesting when you think about the pandemic. It was the 100-year pandemic. What happens in the 2030s if maybe we have a repeat of what we saw back in the 1930s? That's kind of scary. But we'll be 20 years into this bull market by the time we head into the 2030s. I think these next 8 to 10 years are going to be some of the best years to invest in the stock market in our lifetime. What comes after that? You know, rates will probably start going up. Remember the 1960s. This is my last comment. We'll get back to questions. 1960 started with incredibly low interest rates. Interest rates went up the entire decade. That but the stock market kept going up. But we had these cyclical bear markets along the way. So we're going to be challenged, I think, in this decade. But I do think the overall trend remains to the upside with these scary periods along the way. And you just got to kind of look for the signs. Fortunately, I saw enough signs back in December where I said, we're probably going to get off to a very rough start. I remember the article I wrote, it was on December 31st. You can go back, I think it was in Chart Watchers. Or maybe it was in Chart Watch. It might have been in my Trading Places blog. But right at the top, I didn't wait for the market to sell off for 3 weeks to start talking about a bear market. I mean, I talked about it before the market even went down a drop. But it's because of those signals. So as long as we get some good signals, we can kind of navigate, negotiate our way through these cyclical bear markets. So I think right now we're going to have to play it by ear and just see how the market evolves throughout the year.
All right, let's do this. Let's wrap up with 2 questions. Anybody, if we answered a lot of questions, Tom did. If we didn't get your questions, and it's really important to you, you can always write us support@earningsbeats.com. And sometimes it takes a little bit of time to get back to you depending upon what's going on, but just wanted to, we need to sort of wrap up. So 2 questions. Let's start with this one. Okay. Hello, Tom. You guys are great. What do you think about the close we had in the markets on Friday going into the 7th to 11th period, which not great returns based on data you provided in the past? The reason he's asking, he's got Amazon puts. Looking for a drop in Amazon with the next couple of weeks.
Well, Amazon, I do think Amazon's at a rough spot. I wrote an article about Amazon, big earnings, big gap, big problems. And in that article, first of all, I love Amazon. I think it's a great company. Their customer service is almost unmatched. I mean, they're one of the best. I think they do a lot of things incredibly well. It's really tough for their competition because they're so good at what they do. I can't even believe that you can order things online, just shows up at your door in a couple hours. I mean, that just is ridiculous. But anyway, getting past all the fundamentals, technically, Amazon broke down below 3,200. I don't have the chart up, but if you look at your chart over the past several months, you'll see Amazon had multiple tests of 3,200 at support, and we broke below that. Now we're coming back up. I know it was good volume. I know it was earnings. The thing that's kind of interesting, though, is we were at 3,100 before we took the big dive the day of earnings. And then with earnings, we go up 350. It seems like it's a huge number, but it was almost like just getting back what we just recently lost. So I still think the overall chart on Amazon looks very challenging. Relative strength on Amazon is horrible right now, horrible. So I actually like that short position or the puts, but I would be watching 3,200 to 3,300. If we close above 3,300 on Amazon, I'd be a little bit less bearish, a little less bearish. But I do think Monday next week, I mean, we could go down, and we've got options expiring in a couple of weeks. You mentioned you have puts. I don't know what the numbers look like on Amazon as far as Max Pain, but we'll be getting into that when we do the Max Pain event. What is today? Today's the 5th. So it'll be not this Tuesday, but next Tuesday will be the Max Pain event. And that's for members as well. And anybody who signs up for a 30-day trial certainly can come in for that. But right. Yeah, I that one, Amazon, the entire market, I think, finished weak on Friday. I mean, who knows how the market's going to open up? I would expect it to go down based on the fact that I think we're rolling over. But I mean, we could wake up to futures, S&P futures up 50 on Monday. I mean, anything's possible when you get the volatility index where we are right now.
All right. So we have one final question before I want to mention again, if you're a trial member, this is about as good a time as any to give us a shot. We've got, I think, 7 or 8 events coming up between now and the end of February, of which a number of them require a commitment, to at least a 30-day, membership, trial membership. So if you're not on the trial membership now, and you can join for 0 cost, and you'll get access to all the events coming up. And if there's ever a time, to really be vigilant in the market, this is certainly it. So make sure you consider that. So the last question here, which is a good one to end on. What is the length of secular bear markets before it becomes a full bear?
Well, if you look at history, secular bull markets generally last about 2 decades. 1950s and 1960s was one secular bull market. We had cyclical bear markets in there. We actually had recessions in there. So don't think secular bull market means we can't have problems. It's the asset class that is in favor over an extended period of time. That's what creates these secular bull markets. It's not that the economy is strong every time you look at it. And that's what a lot of folks don't understand. So you can still have periods that are bad within secular bull markets. 1950s and 1960s was one secular bull market. 1980s through 1990s, another secular bull market. And I believe we just started in 2013. If we go out 2 decades, which is similar to the last two, that would take us into the early 2030s. We're just starting 2022. Now, again, I expect that we're going to have some ups and downs, but I believe in 10 years, the S&P 500 will be probably 18,000, and we're sitting at 4,500 right now. But we'll have some 20% moves down at different periods, and then we'll rally back. Maybe we're at 15,000 instead of 18,000. I don't know, but I do think we're going to be a lot higher in another decade from now, simply because with interest rates so low, and this goes back to my background in public accounting, I used to do valuations. When interest rates are low, valuations are going to be much higher for a couple of reasons. Number one, future earnings and future cash flows gets discounted back at much lower interest rates, which results in much higher valuations. And then number two, where are you going to put your money? I mean, that's a lot of investing is about alternatives. Where do you invest? Are you comfortable enough that you don't believe in the stock market, that you would be willing to put your money into a 10-year treasury at under 2% a year? You're going to earn 2% a year. Heck, this year, inflation is going to, potentially be 6%. You're already 4% down before you even get started. I just don't see money rotating long-term away from U.S. equities into other asset classes. Short-term, absolutely. I think we're going to see money move to the sidelines. I think you're going to see selling in the bond market to send yields higher, and I think you're going to see selling in the stock market. And then there's going to be a ton of money on the sideline when we bottom. And that's why I think there's going to be one heck of a rally some point later in 2022. And hopefully we'll see some signs to catch it near the bottom. All right, that's it for me. So we'll go ahead and close it out. Like John said, if I didn't get to your question, you do have a question, send it in to us at support@earningsbeats.com. I'll try to get that answered for you. Just have some patience because we have a lot of things going on. It's really hard sometimes for me to get back to questions. But give us a shot at Earnings Beats. I think we do a great job for our members. Tremendous guidance. Portfolio's been rough. But hey, ask IBD, that innovator ETF that they have, or ask Kathy Wood over at ARC Funds. If you invest in mostly growth stocks, which is what I invest in, and that's what we invest in primarily, or we talk about in our portfolios, because those are the stocks that in a secular bull market over long periods of time are going to do better. Short periods of time, as we have seen, when there's talk of inflation, there's talk of higher interest rates, these stocks are being absolutely abused to the downside. But there will be a day, and it's coming sooner and sooner, where these stocks are going to absolutely explode back to the upside. So I think the portfolios will be fine over time. Short term, yeah, as long as we keep dealing with what we're dealing with right now, they're going to struggle. But I'm going to give you some good companies on February 19th, or I think we'll do it on February 20th, which is a Sunday. When I go through and do those portfolios again, it's going to be mostly growth stocks because that's what we do. But when we start to rebound, I do think we're going to see massive moves in some of these stocks. Anyhow, that's it. Keep in mind, we've got 2 big events coming up the next 2 Saturdays, 2 more educational events. Next Saturday is going to be one of my favorites because we're going to be looking at cyclical bear markets, the anatomy of cyclical bear markets. And if you want to see what we might be looking at in 2022, there's no better place to go than history. So we'll be looking at that next Saturday. Listen, everybody have a great rest of your weekend. Glad you made it here today. Hopefully you learned something, and hope it helps in your trading as you go forward. Take care, everybody. Happy trading.